Today, I'm going to show you how to break your company on purpose, on paper. Why? Because the only thing worse than your deal falling apart is when your business falls apart after your deal closes. This is the third video in our series on how to evaluate cash flow in small business acquisitions. Okay, we've talked about debt service coverage ratio and your minimum viable month, the baseline you need to survive. And we talked about the float, that gap between when cash comes in and goes out. But here's the truth. Businesses throw curveballs, and you have to be able to predict when they occur. So in this video, I'll show you how to stress test a deal so you can see how to survive the real world, not just your spreadsheet before you buy. My name's Walker Dybel. I am the Wall Street Journal best-selling author of Buy Then Build, founder of Acquisition Lab. I've been buying companies since 2006. I've spent millions of dollars doing it and taken on millions of dollars in debt, and I've helped hundreds of entrepreneurs buy and grow profitable companies. And one of the biggest lessons I've learned is that you can predict the future, and really well, if you know how. That's why we're digging into cash flow stress testing today, okay? Is to find out what it'll take to starve your cash balance, because you need to go in with two eyes wide open and an understanding of how your cash flow works. I once had a company where twice a year my supplier would introduce new products and I had to buy them. I had to buy them, whether they were going to do well or not. So it was just tying up cash. It was this big cash outlay. And I could usually predict when they weren't going to do well and when they, we're just trying to come out with a product for trying to explore the edge of the market, when in fact I had like 6 products that sold all day long and that's all I wanted to sell, right? And a lot of them were really big cash outlays to me with smaller and smaller margins. So it just tied up my cash. And of course they weren't doing this, not with momentum before I bought the company. So this was a surprise, okay? It's a perfect story of when you have these surprise cash outlays that you weren't considering at the beginning of the acquisition, right? So in the lab, we teach everyone to break our companies on purpose on paper so that we can understand, how much weight it can take. And the best way to do this is with a 13-week cash flow model, because 3 months is long enough to see seasonality, but short enough that you can see the exact timing of cash in and cash out in terms of what's right in front of you and what you can impact. Here's how to do it. Start with your weekly cash inflows. When does the money actually hit the bank? Then calculate your outflows. And I don't mean don't average it. I mean, give the actual number. Round up to the nearest 10 or 5 or whatever. You don't need pennies. I want to know what the actual number is with real dates and, accurate amounts, okay? Then identify, the lumpy killers, okay? So 3 payroll months, quarterly tax payments, insurance prepaids, annual software payments, inventory purchases, annual bonuses to employees, predictable capital expenditures, okay? These are the things that don't show up in the neat, even lines on a spreadsheet or even on the P&L at all. Because, for example, even inventory, if it's on an accrual basis on your income statement, doesn't reflect necessarily the cash outflows that are needed, over the varying seasons across the year. When you lay this out week by week, you can see the valleys where cash gets dangerously low, even when your monthly averages look fine, okay? That's when you know whether the deal can survive real-world pressure in the off seasons and also pay you a living wage, okay? You're not just looking at a pro forma, right? Imagine you're buying a company with $300,000 in monthly revenue just on average, okay? $180,000 in expenses, just cost of goods sold, OPEX, a $40,000 SBA loan payment. Okay, on paper, that's an $80,000 margin per month. It looks safe. What if revenue drops 10% one month just due to a customer's orders being concentrated to one season instead of another? That's $30,000 in cash gone. Now you're at $270,000 in monthly revenue, $180,000 in expenses. That's $90,000 left. You subtract your $40,000 SBA loan, you're profitable by $50,000. Not bad, but you're down 40% from your average. Do you pay yourself the same amount of money that month? I'm just saying, these are the types of questions you start asking yourself when you're living the cash flow roller coaster. If revenue slides 20% from the average, say during the summer months, okay, that's a $60,000 hit, and you're suddenly break even after paying the bank, okay? Now, say customers pay 15 days late. That means you're floating half a month of sales. Okay, on $300,000, that's $150,000 stuck in accounts receivable. Just having to pay 15 days earlier might pull $90,000 in cash need up into that month before the revenue comes in. You start combining this or compounding it with late collections, okay? And you could be short by nearly $250,000 in a single month. I'm not kidding. This is possible. Just do the math so you understand it, okay? This is what being a small business owner really is. Here's the kicker, okay? It's not always just one of these, right? It's late customers, tight vendors, all in the same quarter. This is why we stress test the model before we buy so that we can understand the business the same way that the owner does. As first-time buyers, we like to ask for all of these, complicated reports, and it's fine. But like at the end of the day, the seller, in other small business owners, we know it's all about managing the cash flow. I'm not trying to scare you here, okay? I mean, I am a little bit. You can do this, trust me. It's just you need to avoid the mistake, the number one mistake that first-time buyers make, which is just not understanding the cash valleys. A lot of times they just overpay themselves and start pulling cash out of the business because they're looking at averages, okay? There's one more stress test that many fail to do, even though it should be obvious. A lot of buyers right now are putting in place a 2-year standby on a seller note. And the reason why is because the bank treats it like equity, so it increases the debt service coverage ratio in order to get a deal done. But the bank doesn't calculate a second DSCR for when the seller note comes back into effect. So what I need you to do is run 2 DSCR calculations, one for when you're buying the business, and a second, keeping in mind that in month 25, the seller note now becomes a piece of debt that you have to pay every single month, and the odds that you have a personal guarantee on that seller note are really high, okay? Here's the deal. The bank doesn't care, okay? So what I want you to do is this. Create that second DSCR so that in month 25, that when that seller note wakes up, you're not caught off guard because you didn't calculate how much free cash flow you're going to have moving forward, okay? This isn't about talking yourself out of a deal, okay? It's about knowing what to expect and understanding how fluctuations should actually impact what you're willing to offer for a deal. It's about knowing the limits so that when the bumps come, and they will, you already know you can handle them, all right? So here's the deal. Many buyers want cheap prices and, frankly, dumb sellers. But most experienced search fund investors will advise you to find a great business and be prepared to pay a lot for it, okay? So whether you're looking for recurring revenue or just needing to understand the volatility, this is exactly the kind of work we do every day inside Acquisition Lab. So when you join, you don't just get, training and frameworks and tools. You get a vetted community of entrepreneurs doing deals and building together, okay? If you're serious about buying a business in the next 1 to 24 months, don't go it alone. Click below and apply to join us in the lab. We are the elite provider and have the highest member to acquisition ratio in the industry, in the world, not by a little bit. We'll see you on the inside.